Hello and welcome to Virtual Investor Conferences. On behalf of OTC Markets, we're very pleased you have joined us for the Precious Metals and Critical Minerals Conference. Our next presentation of the day is from Heliostar Metals. Please note you may submit questions for the presenter in the box to the left of the slides. You can also view a company's availability for a one-on-one meeting by clicking Book a Meeting in the top toolbar. At this point, I'm very pleased to welcome Stephen Sook, VP Investor Relations and Development of Heliostar Metals, which trades on the OTCQX Best Market under the symbol HSTXF, and on the TSXV under the symbol HSTR. Welcome back, Stephen.
Great to be here. Thanks for having me again. Welcome everybody, and thanks for logging in to hear the Heliostar story. As mentioned, I'm Stephen Sook, Investor Relations and Development for Heliostar Metals. At our core, we're a gold growth company. We have a pathway to be able to move from our 30 to 40,000 ounces that we'll produce this year, up to 300 to 500,000 ounces by the end of the decade, organically from what we have in hand in our pipeline. And really what sets Heliostar apart from other growth stories is we have the ability to do that without raising any additional equity. So you get a growth and development trajectory and re-rate without the usual associated equity dilution that comes along with that. I'll walk you through how each of those pieces fit together, how we're able to confidently say we'll be able to grow in that timeline, how we're able to fund it, and the team behind it. I'd like to spend just a second on our title slide as well. Speed, grade, and growth. Growth obviously is at our core. You don't plan to 10x your production without being a growth-focused company. Grade, anyone in the resource space who's looked at any resource stories knows a little bit of grade goes a long way, and we have that in spades at our Ana Paula project, and I'll go through that. But one that often gets forgotten is speed. The time value of money is a real thing. Being able to capitalize on the right parts of market cycles and opportunities can create meaningful value for investors, and this is something we're always conscious of at Heliostar. We're a small tactical team who's able to move quickly on good opportunities we see, and run them to ground, execute, or kill them and move on in short order. And we believe we've had some good success doing that. I will, of course, be making forward-looking statements, and you're welcome to peruse this safe harbor statement at your leisure. So we are a gold producer right now. While we are a gold producer, I really refer to us more as an organically funded developer with our ability to fund our growth from the gold we're producing and the cash flow associated with that. Right now is an incredible time to be producing even a little bit of gold. The margin expansion in today's gold price environment that we've seen compared to the last few years has been incredible. And what it's done for Heliostar is it's afforded us the opportunity to tackle a number of different growth opportunities concurrently, as opposed to having to stage them to match our cash flow. It's a great time to be producing gold, and we right now are certainly taking advantage of that tailwind. The majors like the Barricks and Newmonts of the world are undoubtedly going to make a bunch of money through this part of the cycle, probably issue some impressive dividends, likely make some acquisitions, and come out the other side of the gold cycle essentially the same company. At Heliostar, we're able to harness the tailwind provided by today's gold price environment to be able to materially improve, grow, and better our company coming out the other side, a much larger, much better, much robust business. So our vision, this has stayed static since the founding of the company, is to become a next mid-tier gold producer. So why a mid-tier? I think it provides you an opportunity to be both predator and prey. You're prey insofar as the 300 to 500,000 ounce a year range. The bigger mid-tiers are forced to look at you as an acquisition target. The Oceanas, the B2s, the Kinrosses of the world, the IM Golds, for example. So it's this sort of thing that allows you in the height of the market to be able to be looked at as a potential acquisition target if there's more senior producers are paying high multiples, and we'd certainly take advantage of that if that's the case at the right time. On the flip side, 300 to 500,000 ounces a year, it still allows you some meaningful growth. If you can tack on, let's call it 50 to 150,000 ounces a year of additional production, that's still a notable amount of growth in that mid-tier range. So if the cycle isn't as robust, from our strong platform that we're developing, we'll be able to continue to grow and grow meaningfully by having production in that range. We are a Mexico-focused portfolio right now. We're the beneficiary of a company called Argonauts Golds, and unfortunate decline over the last few years, picked up all these assets in 2 transactions for a mere $15 million. Kind of incredible when you think about it, but it was just one of those right time, right situation, right familiarity between the teams and the assets. The right technical view on our side on a different look on how some of these mines should be treated, and the right contrarian sentiment in terms of geopolitical risk tolerance. We picked up the bulk of these assets about 1.5 years ago when mining sentiment in Mexico is at an all-time low. We thought that was overdone, and that was part of the reason we got these mines and projects so cheaply. So what did $15 million buy us? 2 producing gold mines, La Colorada and San Agustin, our flagship Ana Paula project, which we recently put out a PEA that shows some exceptional economics where we saw a different way to tackle this deposit, and then 2 pipeline growth projects in Cerro de Gallo and San Antonio. At La Colorada, this was a mine going into care and maintenance that we quickly put a 6.5-year mine life on the books and resumed mining in January this year. San Agustin was in residual leaching. We got the first new open pit mining permit under the Sheinbaum administration in Mexico here in July, and that mine will be restarting in the next few weeks, primary ore production. Ana Paula, which is really our flagship operation, as I mentioned, or flagship development project, excuse me, that will add 100,000 ounces at an incredibly low cost profile when we bring it online in 2028, and then 2 pipeline development projects, either of which will add 100,000 ounces a year beyond that. The idea is here that from La Colorada and San Agustin gold production over the next 2 to 2.5 years, we'll generate about $100 to $150 million in true bottom line net free cash flow. That will fund the equity portion of the Ana Paula construction alongside a project finance facility, bring us up to that 150 to 200,000 ounce a year production mark. At that point, if you look at all future peers, they're trading at about $2 to $3 billion market cap valuations. And we think we should re-rate into that same range no differently. What sets us apart is we can do that on our current share count by internally funding the equity portion of that growth. So you should see that 4 to 6x re-rate directly reflected in the share price along the way. Our 2 operating mines are located just an hour outside of their respective state capitals in Sonora and Durango, 2 premier mining state jurisdictions in Mexico. All told, we have about 7 million ounces of resources, of which about 2.9 we have to treat as historic right now at Cerro de Gallo. That's until we were able to put out an updated technical study, which should be released in the next few weeks. So stay tuned for that. And a growing reserve base and a full pipeline of development ounces here that we have our hands on and own 100% of already. This is a little more detail on how we have stepwise growth to get to that 300,000 ounce a year mark by the end of the decade. We're on track to produce 30 to 40,000 gold ounces this year. That'll step up to around the 50,000 ounce a year mark, really driven by that San Agustin restart next year. Up to around the 90,000 ounce a year mark in 2027. Ana Paula coming online in the second half of 28 will really start the true ramp up in our production profile, adding 100,000 ounces by the end of that year and bring us up to, like I said, that 150 to 200,000 ounce a year range in 2029, with then Cerro de Gallo again coming online sometime in 2030 to bring us up to that 300,000 ounce a year mark. The idea is that current producing assets produce cash flow, so we're able to leverage into the next larger growth opportunity that we're able to achieve, and so on and so forth through our growth pipeline. In terms of our capitalization to support this right now, we're sitting very comfortably with $35 million of cash in the bank as of September 30th. Our market cap is actually a little bit outdated. We're just north of 600 million market cap Canadian right now at about a $2.40 share price. We have 300 million shares outstanding on a fully diluted basis, including about 23 million materially in the money warrants. Those are at the 40, 60, and 90 cent level and all come in within the next 12 months, bringing in about $9 million US in additional funds. Those warrants do sit, the vast majority of them in kind of known friendly hands and our institutional shareholders, which include Eric Sprott at the top of our list, owning 15% of the company personally. He came in when we purchased Ana Paula in 2022 and has built about half that position actually in the open market, as well as supporting checks into the company. Steve Land at Franklin Templeton owns 11%, and then Adrian Day's Europac fund. But as you can see, we have a large roster of institutional shareholders, as well as a lot of supportive high net worth and retail groups as well. Our management team is headed by our president and CEO, Charles Funk, who founded the company about 5 years ago. His background as an exploration geologist cut his teeth in the exploration and business development groups with Newcrest Mining in Australia, the group that was acquired by Newmont a few years ago. He came over to Canada about 10 years ago, and his big commercial success here was with Vizsla Silver. He was the VP exploration that led the Panuco discovery for that company, which is now a multi-billion-dollar market cap, but wanted a vehicle that was his own, and that was Heliostar, and that's been his focus ever since. I won't go through everyone on the page here, but a few other names worth noting. Greg Bush, our COO, President COO of Capstone Mining, the copper producer in Mexico for almost a decade. Prior to that, he was the SVP Technical Services for Mexico for Equinox Gold, based out of Los Filos mine. Greg's an incredible mine builder and mine operator, and without him, frankly, we wouldn't have been able to purchase and optimize producing assets. Sam Anderson, our VP Projects, really has the credit for seeing the potential in Ana Paula and viewing that completely differently. Almost 20 years with Newmont, brings that big company experience and threshold of quality into all the reports and projects that we publish and we intend to execute on. Myself, I was recently a sell-side research analyst with Stifel, covering the precious metal space out of Toronto for them for the better part of the last decade. And prior to that, I was a mining engineer at various hard rock underground operations around Canada. So speak both technical and financial languages, so to speak. The last person I'll point to here is Ramon Davila, who helped build First Majestic alongside Keith Neumeyer pretty much from the ground up. He was Secretary of the Economy for the state of Durango for 4 years. He's had incredible reach within the mining world, both in government, permitting agencies, industry. He's a real giant to the mining industry and was a great addition to our board about a year ago. Our 2025 guidance, we expect to produce 30 to 40,000 ounces this year at about a $2,000 all-in sustaining cost. Now you see that 2,000 is somewhat artificially inflated by that San Agustin restart line. That's just a function of math. Bringing this mine online this quarter, we do expect to have one high-cost quarter with a lot of initial costs incurred to restart that operation for relatively few ounces produced. We expect that to normalize around the $1,800 per ounce mark, all-in sustaining cost next year and on a go-forward basis, which is kind of where we see these assets operating at as a whole. In today's gold price environment, that $1,800 AISC affords us an incredible cash margin. Our Q3 operating results showed another steady quarter of execution, producing over $14 million in mine operating earnings, which we have been reinvesting back into the business at an corporate all-in sustaining cost of $1,825 per ounce. We increased our cash position, still a very strong working capital position, and continue to make some very good margin from our operations. Now into the assets a little bit. La Colorada mine, this has been our primary producing asset since January this year, where we started mining from stockpiles. We recently put out a technical report showing updated economics and optimizing the mine plan to show the maximum amount of near-term cash flow for the minimal amount of near-term capex to be able to generate cash to be able to fund Ana Paula, like I said, which is really the goal here. Some very strong economics at our very conservative base case gold price of $2,300 an ounce, some great economics at our upside case, and some just exceptional economics at today's spot gold prices. This is a bird's eye view of the asset. As I mentioned, we've been producing from the junkyard stockpile, which is mined as waste in the 1990s, but drilled, blasted, and hauled to surface, grading 0.2 grams a ton. So we've been mining that for the better part of this year. I've been making some very good money doing it. We have a few other stockpile opportunities that are afforded to us that we'll continue to exploit as we work towards our Veta Madre pit expansion in the top right of the slide. This is a primary pit cutback, about 6 months of stripping for 6 months of production. However, it's at much higher grade, 0.7 grams a ton, so multiples of what we've been stacking on the leach pad to date. Creston then provides another 4 years of mine life at, again, higher grade even still. The thing that Creston requires is another $85 million worth of stripping, which we could comfortably fund from the cash generated from the other opportunities leading up to it. However, it's at a time we'd like to be building Ana Paula, so we're looking at a number of sequencing and or project level non-dilutive financing opportunities to be able to tackle that opportunity. We really view these step forward in these assets in three ways. We spent the last year bedding down a production plan, and now we're executing on those plans and continuing to generate good cash from the assets. The next layer is looking at near mine resource expansion opportunities, and we have a good number of those at La Colorada. From that layer, we're looking at Veta Madre Plus. This is another pod of almost 30,000 ounces of mineralization that sits in our indicated resource category that we're doing some confirmatory drilling on right now to look at committing to an expanded mine plan there. At La Colorada, our first drill program did show that there's some very high-grade down plunge potential below the depth of the open pit. So we're looking at how to tackle this. Is this mined as high-grade shoots, or do we mine this as more as a bulk package? Call it 2 to 2.5 grams a ton on more of a bulk scale. We're going to come back with a dedicated drill program next year, really looking to figure out the full scope of opportunity here and where it fits into our production plan. Beyond the near mine resource expansion opportunities, then we have regional exploration. This is our third layer that we think about how to exploit these assets and monetize them to their full extent. Everything I just talked about was in that main mine trend right in the middle of this page. And everything outside of that has seen virtually no modern exploration and definitely no drilling. For example, that soils target is a 1.2 mile long golden soils anomaly with grades above that of the cutoff grade of the open pit. That's never seen a drill hole. So we're very eager to be able to get to those sorts of opportunities and really show that we'll be mining here for likely more than 10 years beyond the 6-year reserve life currently on the books. At San Agustin mine, this is more of a short-term tactical opportunity for us. Again, this is where we got the first new open pit mine permit under the Steinbaum administration in Mexico. This shows a 14-month mine life that we'll be able to put back into production for about $10 million, all said and done. However, from that $10 million, we expect to generate $40 million in net free cash flow over that 14 months at our base case, at the $3,000 gold price. At current gold prices, that's closer to $65 million in net free cash flow. So a very strong opportunity here for us to be able to add cash to our books for a relatively small investment. We have just recently started, these pictures are a few weeks old now. So you can see the work being done here, removing the topsoil and vegetation at this corner pushback area, which is what contains our reserve, recommissioning our 30,000 ton per day crushing circuit. And we intend and are on track to start stacking ore here on the leach pad in the next few weeks and expect first production from that new ore in early January. This will really be the driver for our production through next year, ramping up through Q1 and then really hitting a steady state and putting a significant amount of cash onto our books through 2026. So that's our bedding down production and go forward execution plan. Again, level 2 here is the near mine resource expansion opportunities, and that's what you see in these black boxes. This is our ability to expand the resource through additional oxide drilling. We think we'll be able to add, let's call it 6 to 16 months through the drill bit here. Beyond that, there's a larger polymetallic sulfide deposit that sits around the oxide gold that we're looking to try and exploit and try and find the higher grade portions of with the drill bit, and that's our exploration layer. So as I mentioned, the idea is really to be able to get to fund and build Ana Paula. Ana Paula is truly something special. This was an asset that had over $100 million invested into it that we picked up for 10 cents on the dollar, including a lot of good infrastructure, a lot of drilling, and really gives us a running start here. This was scoped as a low-grade open pit project with marginal economics and a complicated flow sheet. We took a look at this, and decided, that's not what we're interested in. But if we focus on the high-grade bulk tonnage underground core, that's a completely different project, and that's where 80% of the economics are driven by. So we refocused on that, redid the geologic model, and recently put out a PEA showing some incredible economics on just that highest grade bulk tonnage portion. It's rare you're able to say the combination of high-grade bulk tonnage, and that's really what drives this incredibly low $1,000 per ounce all-in sustaining cost. It's a small mine to be able to maintain. You're able to take large stopes and get the economies of scale of mining without having to maintain a lot of underground infrastructure, without having to maintain a large plant, and you get some incredible cash from being able to do that. So all told, our PEA showed just over 100,000 ounces a year after ramp up in a 9-year mine life, generating at base case economics just under 95 million in free cash flow a year. If we go up to $3,800 an ounce, that 95 million jumps up to about 170 million in net free cash flow per year. Some incredible economics, which is why we're pushing hard to get this into production. Right now, we're in the midst of a 20,000 meter drill program focused on upgrading that inferred material primarily, that just about 500,000 ounces of inferred. Through that infill drill program, we're also seeing grade come up as well as we're better able to define some of the mineralization between the widely spaced drill holes. The idea here is that in a feasibility study in early 2027, we'll be able to show a 10-year mine life at 100,000 ounces a year from adding additional ounces within the deposit, as well as tackling some positive mineralization we're seeing that would be near planned underground mine infrastructure. All told, we expect this mine to cost about 300 million to bring into production. As I mentioned, about half funded from internally generated cash flow, the other half from a project finance facility that we will start discussions on next year. The other thing worth noting is that this project was fully permitted for the old open pit. So we are submitting a permit modification to go from open pit to underground, which is not a controversial permit to get in Mexico. Our neighbor Torex got that under the old administration, and we expect about a 12-month turnaround time from when we submit that modification in Q1 2026. We're also working on all the technical work that will support the full feasibility study and what will be our go-forward construction execution document that, again, we expect to have in early 2027. And then, the financing discussions. We're going to start this in probably Q2 next year with the idea that by early 2027, or excuse me, in early 27, we'll have a feasibility study construction document. We will have all the money lined up, and we'll have a modified permit in hand to be able to pull the trigger, start our 18 months of construction, and have this online ramping up to 100,000 ounces a year in the second half of 2028. Beyond that, again, similar trajectory, we've got the near mine potential here, additional pods of mineralization. You can see just how close they are to planned underground infrastructure. So part of that 20,000 meter drill program will tackle some of those targets. And then, there's potential we're sitting on a much larger deposit here. Everything we've talked about is in this purple and pink areas in the top, and just kind of down into a few of these down plunge extensions of mineralization you can see in the top right graphic. But we know we're at the highest part of the geologic system. The metallurgy tells us that. And we know our neighbors are absolute giants. So we're going to advance this underground decline through next year to be able to, one, de-risk the deposit, be able to map the geology, take test stopes, be able to see how the rock stands up, things like that, and then use it as a drill platform to tackle a down plunge extension. And why we're excited about that is there's a few results drilled more than 15 years ago that show some incredible sparse results. 14 meters at 30 grams a ton, 40 meters at 6 grams a ton. And just across the valley are two giants. Torex's Morelos complex was the 10th largest gold mine on planet Earth last year. So that's the type of system that we think we could find lower down. That sits in what's called a contact skarn lower down in the geologic column, whereas Ana Paula is higher up. So we're very eager to try and chase that to depth, see if we've got a Morelos or a Los Filos style deposit that could be a multi-million ounce monster. So stay tuned as we get drill results out for that near the end of next year. Bringing Ana Paula online would bring us to 150 to 200,000 ounces a year. And then beyond that, we intend to build our Cerro de Gallo project. This is another project that's an open pit heap leach in the state of Guanajuato, a very mining friendly state that could add 100,000 ounces a year. This is where we have to treat those resources as historic right now. But in the next few weeks, we'll put out an updated pre-feasibility study that'll show the details of where that next 100,000 ounces a year come from. Don't think we're getting much credit for this in the market. So this can be a real incremental step to our NAV growth as a company and show how we get to that 300,000 ounce a year mark by the end of the decade. This is a preview of our news flow and a few of the things we've already executed on the last few months. I can think of it in 3 levels. The first level is our quarterly execution, being able to show that our plan that we've laid out here is working. We're generating cash flow. We're checking the boxes on being able to get these projects going. Our second level of news flow is NAV growth, being able to put out these studies showing just how much value there is in the company and have that validated by a third party to the market. and then drill results for a little bit of sizzle on top. We are drilling extensively at all three of our assets. The 20,000 meter infill and step out drill program at Ana Paula, oxide expansion drill program at San Augustine, and then La Colorada at both the near mine resource opportunities and then moving into those regional exploration targets in 2026. It's now on management to execute, to do these things, continue to provide more check marks here as we continue to execute to our plan, create value, re-rate through growth and de-risking, and create the next multi-billion mid-tier gold producer. Thank you very much for listening. I see we have quite a few number of questions here, so if you give me just a second to look at those, I will start answering them. I appreciate your questions. You have multiple assets across Mexico. How do you view the current Mexican regulatory and political environment? That's a great question. Under the previous regime in Mexico, permitting was tough. There's no doubt about it. However, the new president coming in last November, it's been night and day. We've gotten a number of permits, as I mentioned. The San Augustine permit was the major one, but beyond that, we've received multiple other smaller operational permits, things like permits to expand the leach pads at La Colorada, things like expanding the height of the leach pad at San Augustine, the permits to drill. So things are definitely moving in a positive direction in Mexico, and we're continuing to see those permits accelerate across the industry in Mexican mining, which is wonderful. Ana Paula shows exceptional grades. Underground mining on high-grade deposits can be complex. There's contingency for mining underground? That's a good question. So I'd first start out by pointing that Ana Paula is not your typical high-grade deposit in that it is a bulk tonnage high-grade deposit. And that's really something that's very rare. Most high-grade deposits are vein-hosted deposits, skinny veins of mineralization that are high-grade but are difficult to develop and chase. Ana Paula is unique in that it's not a vein-hosted deposit. It's in silica-flooded breccia body. So for lack of a better descriptor, it's one big blob of mineralization, which is what makes the economics special and drives that. That being said, we do have contingency in our OPEX and in our CapEx to build the mine. So in CapEx, I believe our mining contingency is around the 23% mark. I'd have to go to get the exact number, and I believe that it's around that same amount in our operating cost contingency as well. Given how well Ana Paula and La Colorada are now positioned, where does Cerro de Gallo and San Antonio sit in your capital allocation? That's a great question. We are focused on bringing Ana Paula into production. That is first and foremost and the real driving goal behind the company. La Colorada, again, as a kind of a second level of allocation, being able to look at those growth opportunities at La Colorada. Cerro de Gallo has been ongoing study work, so we have been putting some capital to work there, and you'll see the result of that in the next few weeks when the headline results of the study come out. And San Antonio is one we didn't touch on much, but it's a longer dated opportunity as we progress some permitting discussions there. So I think kind of the order I described them is kind of the order in which we see our priorities for capital allocation. If a larger producer approached you in a few years, I assume as a takeout target, would you prefer to remain independent and build a mid-period open to a sale to create strong value? The short answer is yes. I think we're happy to continue to grow the company, and I don't think we're anywhere near being able to justify being bought out, except for something obviously off the charts, crazy sort of dollar amount right now. We want to be able to execute on the growth that I just ran through and provide investors with the exposure to that re-rate through our execution before we'd entertain that sort of thing. So, at the right time, at the right scale, with the right price, of course, if it creates a lot of value for investors, we'd be happy to do that. But we are positioning the company to be able to grow it ourselves and don't put our business plan in someone else's hands for a buyout. I apologize to everyone's questions I didn't get to. I'm just coming up on the half hour, but please, you see the email address to be able to submit additional questions. Happy to answer them through that medium if I didn't answer your question here live. Thank you again, everyone, for tuning in, and thanks for listening to the Heliostar story.